Hello everyone, welcome to this new session. I hope you're doing well. In this one, we're going to focus on market structure and the logic behind the market structure, why market structure is formed. So the reason is that what most of the psychological problem when you're just trying to apply techniques and skills that you have learned comes from the logic. Logic means the beliefs and things that you have in mind that they enable you to perform some action. So if you have a logic, if you have a formula, if you have a meaning in your mind, you can tolerate the short-term setbacks while you're just trading. So it means that you're not going to just uh, touch your stop loss, widening it or tightening it or getting out of the trade sooner than what you were supposed to do. Okay. So now the reason behind market structure is selling and buying pressure. Okay. So as you see here, we have an upswing here, swing high, and a swing low. So all of the market is built using these swings. These swings could be higher highs, or lower highs. So based on market structure, and swing lows, is low, lower low, and lower highs. Okay. So how do these swings form? I mean, what makes uh, these swings? What creates the swings? So the reason behind these swings are this battle between sellers and buyers. So imagine that these things that I'm talking about, these numbers that I'm talking about, all are imaginary and for educational purpose. So and you have to know that this is an educational video. It is not financial advice, by the way. Anyways, let's suppose that we have 10 institution here. They want to drive the market up. Okay. So they want to just be buyers. Okay. So for any buyers in the market, we need to have some sellers, right? So okay, now let's say numbers of the volume that buyers have is just number 10. Okay, this is just imaginary, as I said. And numbers of the sellers and volume that they have is number 7. So then it means that 10 people want to buy something, but 7 people are selling it. So we have 3 people that they cannot find any seller in the specific price. So what should they do? They need to offer higher price or to go to somewhere else or higher price to find sellers. Sellers are in the high and buyers are in the low. Okay. So if the buyers cannot find any seller at a specific price, there is no way out unless if they want to buy, they have to go to the higher price and pay more for the sellers. And some sellers are just willing to sell when there is a higher price for the whatever they want to sell. It is the same logic in your buying and selling in the traditional market, right? The same logic applies here. Now, look at these swings here. So, these swings, if you look at these swings, these buyers are just uh, finding some sellers. And here, before the swing high and after the swing low, you see both directions are up. Okay? So, we have more buying pressure, means more buyers they're willing to buy, and we have number of the sellers or volume of the sellers, let's say, is less than buyers. So the market goes up and moves the price up. The same here, look, the movement is going up from zero, a difference between buyers and sellers, to a number of the high buyers are more than number of sellers or volume of buyers, let's say. So then after swing low, which was here, and before swing high, what do we have? Amount of volume buyers want to buy from seller is more than volume sellers can give, can provide. So there is no way out unless price moves up. So, but then we have some peaks and valleys here. Swing highs are our peak, and valleys are our, swing lows are our valleys. So let's say here the difference between the volume of sellers and buyers is zero. Here it is the point of, let's say, balance. Okay, number of sellers and number of buyers are the same. No difference between the volume. Okay, so the difference is zero. Okay, why? Because on the other side, after these swings are made, okay, here also the swing low is made, okay, so coming down. So we have on the other side, we have more buyers than sellers after swing low, and we have more sellers than buyers after swing high. Okay, so it means that for a temporary time at the peaks and valleys, numbers of the sellers and buyers or volume of sellers and buyers must be the same, unless we cannot have these turning points. Okay, so for example, let's say from 10 numbers of the buyers becomes 9, 8, and sellers become, let's say, here we have like 6 buyers, 2 sellers. Again, buyers go up, 7 buyers, let's say, I don't know, like 4 sellers. It goes up, 5 buyers and 5 sellers. Here, price doesn't move up anymore because it doesn't need to have more movement because they have an available amount and available number of sellers. Okay, buyers need the same, and the same here. When we have a lot of sellers here, like 10 people are selling here, and let's say 3 people are buying from them, then again they go down and find seller. These sellers go find some buyers, okay, to sell. So numbers of the sellers are getting less, okay, and numbers fewer. It gets, number gets less, and numbers of the buyers increasing here. Now in this moment, let's say numbers of the buyers and sellers both are, volume of their demand and supply both are like say 6 and 6. So if you just subtract them, it becomes 0. For a period of time, they had no difference in volume, right? So later, numbers of the buyers or volume of the buyers and people that they want to buy or demand is more than people that they want to sell. Okay, so it's moving up to find other, let's say, buyers and sellers. So at Peak and Valley, I have just already explained this, right? This is the animation, okay, and the same thing happens here, okay? They're driving markets price down to find more buyers here. Sellers are driving the market down to find buyers, and buyers driving the market up to find sellers. And this in this point and peak of the swings, so the difference between the numbers and the volume of buyers and sellers is 0 because price doesn't go up and down because they don't need to go up and down. There is no reason behind moving up and down. So now here, if you look at these swings that we have, swing high, swing high, swing low, swing low. So by connecting these swings together, we were making trends, right? Now, the first one, we don't know if it has broken anything before. We call it high, and the second one is low. And if we break this high, we have higher high. So, and because we have a low, but this low is higher than the previous low, we call it higher low. Now, the same for the same logic for the downtrend. So we have high, low. So when the low is broken, we have lower low. So again, we have another high, but it is lower than the previous one. That's why we call it lower high. So now, the logic behind these trends, now, where are the buyers and sellers? This is the most critical point that we are coming. two. Okay, look, sellers are here stronger than buyers. Okay, so here we have zero difference between volume, but here sellers are getting more stronger. Or here we have some buyers that they are getting out of these trades. So when you are buying, you put a stop and you have targets, right? So both of your stop and targets when you are buying are sell orders, and both of your stop and your target when you are selling is buy orders. So now the names and labels are different, but the executions are the same. So when you are your stop loss or take profit when your buying is triggered, it means that you're selling. Okay, so here numbers of the sellers are stronger on top of highs and highs. Okay, and numbers of the sellers or volume or willingness of the sellers, buyers behind lows is more. Okay, so here again the same logic. Also we have it here. Okay, so now this difference between sellers and buyers, okay, now makes swings. Then swings combined together, they make what? They make trends or patterns, let's say, right? Not all the time we have uh, trends. Okay, trends are one of the different kinds of patterns. Now, how do we have the formation of these legs? Look at them. The same fractal movement that happened here, they're happening inside these legs, right? So when we have this movement, the same logic happens behind this. Okay, lower time frame create higher time frame, right? So but how? They're creating higher time frame with exactly the same similar movement, because price can go either up or down. It cannot go in on any other choices. It doesn't have any other choices. Okay, so that's why it should create the same similar patterns. Okay, now we said by we fractal model. Okay, this is the fractal model. Okay, so then look at this one. If you want to just take trades, you have to take trades when we have trendy pattern in one side. Let's say if it is uptrend, you have to buy. So you're going to buy here. Okay, let's say, or you're going to buy here, and sometimes you can buy here, but look at the difference between these two. Okay, when we have our higher time frames going high and high, although it is made after lower time frame is made. Okay, but because of the fractality, we have to trust this. Okay, we say that although our lower time frame is making our higher time frame, we can trust that our higher time frame will follow the same kind of fractal movement that lower time frame had. Okay, this fractality is always visible in the nature. Okay, so you can Google it, or you can find talk about search about, I don't know, Fibonacci or other just triangles and stuff like that. Okay, so the only thing that you have to trust is fractal model. In trading, if you don't have any logic, if you don't trust something, you cannot stay in the trade long enough to have your profit, or you cannot accept your stop loss, because there is no reason that you're doing these actions. So your actions and behavior needs to have something you can rely on, logically, mentally, right? So the same kind of fractal movement is in the downtrend. So as you see, we have here buying and selling pressure again uh, in the swing, and swings that they belong to the lower time frame, right? Because this leg in the higher time frame is nothing except a trend in the lower time frame. So you cannot see these details in the higher time frame, but if you break this leg down, you can see it in the lower time frame. This buying and selling pressure at the top of this peak, okay, they come to the equilibrium. They become the same. Okay, the difference becomes the same for a moment, but overall inertia continues. So the only thing that you can trust in market is inertia, especially in the beginning of when we have trend is forming. Okay, so when we have high low, higher high, lower low, so we have um, five legs, one, two, three, four, and five. In the beginning of five, we have our trend confirmed, right? So we have up moving trend. So if we draw the trend line or channel, so the same stuff happens inside the last leg, right? I mean, inside these legs, also inside last leg. So here our higher time frame trend is confirmed, and here in the third one, I mean number four, our lower time frame trend is also confirmed, right? The same here when we have this downtrend. Now, one, two, three, four. When the swing is forming, our downtrend pattern is uh, formed. By the way, you don't need to have this equal trend line. Sometimes it could be widening, it could be, becoming like a triangle, narrowing like wedge, right? So as far as it is moving up, we call it uptrend. As far as it is moving down, we call it downtrend. Because if you go to the market, you cannot see this beautiful all the time. They are not like this beautiful parallel lines, right? Channels. So the same here, after our swing is here, formed, it confirms our trend, downtrend. And the same thing happens in the fractal model, right? So after here, so after fifth one, so we have this trend line. So these areas are the highest probable one to take trades. So here you can go buy based on these swings, and you can go low, sell short based on these swings. But higher time frame fractal mode and pressure supports your lower time frame ideas as well. So some people would say that, okay, I'm not comfortable with trend lines. I want to just use pullbacks, valid pullbacks, or Ganlick, whatever pullback, or market structure. It's up to you. As for it is giving you an uptrend, so giving you a logic behind your swing formation. So it is okay. It's gonna work for you. You can stand in the trade, and you can get your target, and you can accept your stop loss because your idea and logic is not valid anymore if your stop loss is hit. So the same stuff here. Some people like trend lines, some people like counting legs here. So look here, the same stuff happened in the lower time frame, in lower scale. So this is in higher scale, this one is in lower scale. And the reason behind these movements also is supply and demand. So I have already had a lot of videos about these kind of things, right? Valid pullback legs and supply and demand, FTRs, and so on. And you can watch some, recently I have uploaded some videos, live videos. The concepts of trading is just based on this simple market structure. So now this is a valid pullback or pullback. Okay, so it is downtrend. Here the same idea happens in the lower time frame when we have higher time frame valid pullback form, and also lower time frame valid pullback form, and they're aligned. So it means that we are in the high probability trading area, right? So, and also we have to just bear in mind how sharp is this movement? What is the slope of these channels? Okay, in mind, it doesn't matter if you're just trading, drawing the channels or no. The sharper this movement is, the more the, momentum is, and the, more high probable it will be. Not only this bigger channel, but also this lower channel, which is a leg in the higher time frame. These two momentum should support each other. So this makes your probability increase from 50% of blindly just taking trades to at least more than 70 to 75% at least. So now, when is the trend changed? The direction of the trend changed. So we have a very popular and very effective model and actually pattern of trading when it is turning point. They call it Quasimodo. I don't know. Previously, they were calling it, um, I don't know, head and shoulders. Or but this head and shoulder is different. We have to break I mean the last swing low, and we have to break last swing high in order to just have this kind of model. Okay, so the logic behind this turning point, so we have to just confirm that this turning point happened. I mean that the end of this pullback, I mean end of this trend should be confirmed mechanically and systematically, not just based on your idea. So look here, we have high, low, higher high, and then this low is broken. Okay, and we have a new low. But is it the starting of the downtrend? No, because it could easily go up and give you just another just widening wedge. Okay, widening, let's say, channel, and continues with its own I mean trend later on. Later we need another high. Is our downtrend confirmed? Not yet. But here, when it is the low is broken one more time, so we can say that yes, our downtrend has started. Okay, this is starting a downtrend. So let me go back and talk about this in the bullish scenario. So here we have low, high, lower low is formed. So this last high is broken. Okay, now the retesting of it usually is in this one. I mean this part, and retesting of this high is the, I mean, previous high here. So and this one is there. As far as this is broken, and what is the reason for that? It must have the reason as well. You can just see it frequently on the chart. So now the reason is that our last selling pressure that was strong, I mean the strongest selling pressure exists here, right? Then maybe these sellers just add into their position to drive the market down, and so that these buyers cannot stand this volume. Okay, so this low is broken, so the buyers are defeated here once. Okay, but still sellers are in control. Not only these sellers, also this one as well. I mean these people, maybe these ones, I mean these people that they are, maybe they're the same, they're adding more to the position to turn the market down. Okay, these are institutions. Okay, there is nothing like stop loss or something like TP for institution, because it doesn't make sense. We don't have a lot of people to just sell for them or buy from them, right? So it doesn't matter. I mean retail traders have sellers and buying, I mean stuff. So now this is this area, I mean from here, I mean to the higher high, is the last line of defense for sellers. Okay, and the same stuff here. Okay, this a low area, I mean buyers added more to drive the market up, to just make the a structure change, right? These two, or this area from a low to the lower low, is the last line of defense for buyers to drive the market up. Okay, it happens in all time frame. It has also a fractal model, right? So here, if you look at this, in this point we have end of uptrend, but we don't have the start of downtrend. This is very important. Start of downtrend is not here, and start of uptrend is not here. It is just end of downtrend. So when we have start of downtrend, so whenever at least we have this one is broken, this one is broken for uptrend, right? Now, and actually, if you want to just be a little more cautious, you have to just wait for this one to move. I mean, for why? Because this is the end of downtrend, I mean uptrend, but startup downtrend should be based on 1, 2, 3, 4 what swings to give us what the model give us the pattern, right? Downtrend pattern. The same for here. This is the end of downtrend, and the start of uptrend is just when we have 1, 2, 3, 4 swings that we can connect them together. These are swings that we can connect them together to form our trend or model. Can we use this high and low and this ones as these belongs to the previous ones, previous trend, previous leg? I mean that these swings and this swing belong to the previous uptrend. Okay, this one and this one belong to the previous downtrend. Okay, but for the sake of just forming the direction, because we're not just trading based on trend line, forming the direction change, you can, yes, not only you can connect these two and form the new one. Before this one is formed, this one is formed, you can also connect these ones. The previous ones. Wait a second. We have to have one more here. But which one is more trustworthy? The black trend lines, right? Not this orange ones. Okay. So, and the direction is confirmed when we have at least 1, 2, 3, 4, and in the start of the 5 we have our uptrend confirmed, right? Now look at them on the chart. Now, where are buyers? Where are sellers? Here in the real market, we have these buyers and sellers. Okay, when we have this one is broken, so now sellers go up, and buying pressure is high here. This one is here. This one is here, right? The same. And sometimes we have some swings inside the swings. Okay, here is the end of down uptrend for this one, but it is not a start of downtrend. Look at this one. Now we have end of downtrend, but look at this wick. So if you assume that, okay, let me go short here, your stop loss would be here, right? Your stop loss is hit right away. Now it comes down, it gives us one. We cannot count from here because this is the highest one. Okay, so we're going to count from here. 1, 2, 3. Okay, so here you can consider this one as swing as well. Yes, it is possible. But do we have any trade here in the lower time frame? You could have trade from here to there as far as your stop loss and take profit is enough. But we have what? Buying pressure in front of here. You cannot go short here, right? Now trend resumes, continues, and here again uptrend starts, right? From here again, 1, 2, 3, and it goes on. The same is for selling pressure. Selling pressure is more dominant here than buying pressure when we have downtrend here. So these scenarios that we have here, if you go to any of these legs, okay, the same scenarios of buying and selling pressure happens there, right? We have the same stuff which is happening there. Now look at this one. Now we have this swing, which is swing low. We have buyers, they are stronger here, and we have sellers who are stronger up there, right? They want to drive the market down, and they want to drive the market up, right? The same stuff here inside these fractals, this happens, right? They want to just drive the market up. Now we have buying pressure here, which is dominant. These two forces are more stronger than one group of sellers here, right? Again, it continues up the same. So we have selling pressure here, we have selling pressure here, we have selling pressure here. These two grouped together have stronger down pressure rather than up pressure here. Now that's why we have a matrix, right? So when we have trading time frame and swing time frame, they could be either up, down, or sideways. This is our trading time frame: up, down, sideways. This is our structure time frame: up, down, sideways. So if we have structure time frame which is up, going uptrend, we have trading time frame which is going uptrend, both of them go in the same way. It means that in the same direction, they're aligned. So it is more probable to go long, right? And the same is true for this one. When we have a trading time frame which is going down and structure time frame which is going down, we have downtrend. These two just actually work together to drive the market down. Other than that, look at this one. So out of 9, if you're just combining these two time frames, we have just 2 scenarios that they're high probable. That's why you cannot, that's why whenever you're just trying to open up a trade without thinking and logic, usually it moves around and it doesn't go toward your TP easily. Okay, so that's the reason. Out of 9, we have just 2 scenarios that they are high probable and they go the direction you like it. So look, the same stuff happens here. Actually, I have talked about this. So inside this legs, so when we want to just take trades, let's say we have started counting the structure here. We have low, high, higher low, I mean, then 1, 2, 3, 4. Now from this time we can go down and to the lower time frame start to do the same stuff there. So count the legs in the lower time frame. If it is the 15 minutes time frame, so you can go to the 1 minute, and if we have stronger move, very strong sharp move, even you can go lower than the 1 minute time frame to find their own fractals there, right? To find their own swings there. Now look, the scenarios that we have, which is high probable, is that we have we have to have higher time frame trends, 1, 2, 3, 4, and in the start of the fifth one, we can say that okay, our uptrend is just formed. Now, what about lower time frame? If you just go to this leg here, we have a lot of movements here, but we don't care about these, right? The only thing which we really care about and which is high probable is this area. Again here, 1, 2, 3, 4, 5. Okay, but you have to just see that which two time frames are matching, and you can see these swings that you cannot see in the higher time frame. These swing 1, 2, 3, 4. I mean the small ones, you cannot see them in the higher time frame. The only thing that you can see in the higher time frame is just candles, and you're only um, looking for hunting and trading based on the candles of the higher time frame, but based on the logic and swings of the lower time frame. So the same stuff happens here if we want to just do this. Look, we have 1, 2, 3, 4, 5. Now we're looking to hunt this area in the lower time frame. This is 1 minute of this 15 minutes time frame that we had, right? So here you're looking for buy scenarios again, right? Now here we're gonna go like this one. 1, 2, 3. Okay, after, I mean, we have this 3, it's going down, it doesn't give us I mean number 4. Okay, right? So 1, 2, 3. So it doesn't break this one actually, right? So it doesn't give us 3 higher high, which is second higher high. So now that's why we can say 1, 2, 3. Okay, this is better. Even we have some swings there. Okay, you can hunt the swings up there. And also here we're interested in number 7, right? Again, 1, 2, 3, 4. At the end of the 4, we're looking for what? Overbought and oversold area. You remember those lessons, right? Then look, this is the same stuff. I'm just zooming in a little bit. Okay, this is the fifth leg. Yeah. Now 1, 2, 3, 4. Now it is 50% of what? Fibonacci. So you can go long, and if you want to take 1-to-1, it's going to deliver to you. It is very high probable, by the way. Now here the same. So this is low probability trading area. This is high probability trading area. This is again high probability trading area. Yeah. 1, 2, 3, 4. Now that means yeah. Here again you can go long, right? So do you know that it's going to go up? No. But is it high probable? Yes. How likely it is going up? It is more than just 60%. Is it enough for you? It is more than enough for me. So now this is the same area in the previous one here. Okay, now look, I'm putting the numbers on that, zooming it. So 1, 2, 3, 4. Again 50%. So I'm not going to say that you're going to just take trades out of 50% of Fibonacci, but I mean that even if with the very simple just Fibonacci, okay, you can buy it. Let alone you can use just swing high, I mean ballot pullback, ballot I mean zones. Okay, so you're gonna give you just exactly the point where you're supposed to buy and when you're supposed to sell at the end of pullback. So now in the downtrend, here we have this trend which is going down. This is formed. Here we're just interested to trade downtrends here, right? An uptrend, we're just interested in trading these areas. Okay. Now here, what about this ones? Can we go short here if your just expectation is low and we don't know if it is just going, I mean, this bigger one is going to give us just 25% pullback, retracement of FIBA, I mean, 50%, or it's going to give you the shallow pullback. So if it gives you just shallow pullback, so I mean that you're just supposed to weigh your options, okay? So you're going to just put a lot of emphasis on the side that gives you the, I mean, more chance of profitability rather than just going blindly and taking trades and try to take the reverse trades, right? So that's why high probable areas are first best one is here, later here, and the number one even, but these ones are secondary. So we're trying to avoid this low probability trading area, low probability trading area here. And in the downtrend scenario, the same stuff. This is low probability trading area for downtrend, low probability trading area for downtrend, and this one. And also you have to keep in mind, I'm just repeating myself, how strong this trend is coming down and how strong this leg is coming down. If they're both strong, so not only trends are on your side, momentum is on your side as well. So you have high chance of winning the trade. Now, next time I'm going to just talk about the structure and transition. So it is this video is too long for this session. Okay, so actually we're going to go and talk about this stuff there as well, but it's going to be a little bit more systematic and based on the leg counting and high-low and patterns, and these are so important and crucial. Take care. See you in the next one.